Hello and welcome back to another episode of the Aleph Zero Podcast. In recent episodes, we've discussed many technical points regarding Aleph Zero and those involved with design decisions. And what we haven't done is looked at the business side of Web3, specifically the venture capitalist landscape, or VC for short. I'm Matt Raczynski and I'll be your host, and today I will be joined by Piotr Saczuk, who for many years has been involved with the VC space, and he joined the ALF Zero core team recently as ecosystem investments manager. So welcome to the show, Piotr. Great to have you here. And before diving into the nitty-gritty of venture capitalism, let's start from the beginning. What brought you the VC space? What was that, through your education or something else?
Hi everyone, happy to be here. So I think that was pretty pragmatic, and I got my background in sports. So I've been a sportsman like on semi-professional level for around like 8 years, something around this, competing a lot. Then
What
I
did
got
you do in sports?
martial arts. So I started with boxing. Later on, I done
Nice.
kickboxing, and I finished with MMA, but I got my skull broken. And I thought that this is time to switch to something else. And some colleagues showed me trading with leverage on Bitcoin, so I don't have to be KYC'd or whatever. It was like barrier to entry was super low, and you could go with leverage as high as 100x. So pretty a lot of adrenaline, pretty similar feeling like I got in sports, and I got tracked few times, but it made me being interested more into what's behind the charts and what this Bitcoin actually is. So I just knew after finishing my sport journey that I wanted to be involved more in crypto when I started to learn more about economy, monetary policy. So I started being interested in Bitcoin as like hard money, sound money concepts, been reading a lot about the Austrian School of Economy, of which I'm still fan, I would say. And but the area of VC and why I wanted to enter it was pretty pragmatic. So I knew I want to go into crypto and that I want to earn decent money. And it seemed a pretty good spot to be. So I imagine that being investor is more or less chilling 50% of time and then just taking few decisions per day if you want to invest or not. In reality, it's much different, but it's
Per day, you're more like a trader, right? I've heard like investors, like, in one investment per year or a few, and you just then chill.
Yeah. So depends, like also from which perspective you look at it. You can receive really a lot of pitch decks and like approaches coming from the founders, and you can review really a lot of stuff per day. And in the end, you take this decision every day. Most of those decisions gonna be that, hey, I don't want to invest into this one, and that's it. And then you just look into something which is actually interesting for you and where you see big upside. And sometimes it can be maybe even that once per year you will gonna do an investment. Also, it depends on how you venture fund is structured and how much time you got to deploy all of the money. But it's rather one bet and like one investment for, let's say, 100 pitch decks or ideas you see.
Yeah. So that was your work at Tsunami, right? When you were working as
I was an analyst, so I was the only investment team member beside the partners. So I was involved in all of the stuff around investing. But as we ran an accelerator, I was also involved in the commit portfolio companies, mostly on the BD side. But also what was pretty interesting thing was working on a fundraising, because like funds raise their money also from other wealthy people or from other entities, other funds, whatever. And I've been involved also in fundraising our second vehicle, and during the bear market. So that was pretty fun.
Yeah, probably for a VC, that's like a shopping spree, right?
it's very interesting to see how this works, behind the curtain, because normally what you see is a VC firm which is just deploying money, and you see those investors, like VC investors, as people who owns this money. But this is not the truth. So most of VCs are just money managers. Of course, they got their chunk, they part in a fund, which is normally about 1%, let's say, at least, of the assets under management. But some of the guys are doing much bigger. They're committing 50% of a fund, for example, and only 50% they're raising from outside investors. But you see this reality that as an investor, you also have to prepare a pitch deck and sell your services, sell your product to other investors, that you're the guy who gonna be managing their money wisely, and you're gonna get them returns, which have to be pretty big, because if they're not, it's probably much wiser to put money in some ETF, which is tracking S&P 500 or whatever.
Yeah. So there's this common thought that VCs often operate on, the spray and pray principle. People usually say that, if a VC makes investments and, 9 of them are losing, but 1 out of 10 is the winner, and that's good enough for them. Is that still the case?
Yeah, I think so. It all comes to power law. So in real world or daily life, you see that you got statistic and you got the average. So average height of a man in Europe, let's say that's gonna be 1.8 meters, right? And then it's the more you go into each of the directions. So let's say I wanna look for 2-meter tall people, it's gonna be pretty hard. In VC and in investments in startups, it's working in completely different way. So in most of the cases, all of the upside gonna be generated by just a few bets you've made. But to achieve such a good result, you still have to think about each investment as this one which got potential to become a unicorn. So I would say that this spray and pray attitude of Tigers Global or whatever other funds which you think of when you think of such an attitude is just bad, probably won't generate any returns. And in the end, then your firm is more like indexing the market. And if you're indexing the market, then you can't expect returns bigger than the market average gonna generate, which are not enough for limited partners. So people who invest in VCs to get much higher returns than they could
because
get.
The risk is high, right?
That's
the case here.
That's true. So even if if you think of every company you invest in as a unicorn, most of them probably gonna go bust. And still, in crypto, whole Web3, this is very new market segment, and probably most of the use cases we even interact today with won't be relevant at all in 5 or 10 years, and nobody gonna be using that. So we're still, I would say, from this perspective, very early, because we're not sure what we want to do with this technology. And that's why it's still so exciting for investors to look for this killer use case, which is gonna change life of a lot of people, and not only folks who are already interacting with crypto.
Right. So we were talking about this high risk, high rewards for operating model for VCs. But as you said, it's not the case. The risk has to be managed. So how exactly would you or did you manage the risk when assessing an investment and then following with that?
Yeah. So also, I think that this question needs to be specified more in terms of in which stage of life of a company you invest in. So if you're an early stage investor, which means you invest in pre-seed, seed, maybe Series A stages, the team gonna be the most important thing when you conduct any due diligence on a venture, because a lot of people think that the most important thing is some Excel with some, financial valuation, like business model, any metrics. But no matter what you're gonna put in Excel, that's not gonna be relevant in 1 year, and you for sure haven't grasped the truth if you do calculations on how your business gonna look like in 1 year when you're on such an early stage. So the most important thing to assess is the quality of founders. Then if they are the delivery people, if they gonna commit really big part of their life to just work on this product, because always if you start doing something interesting, you're gonna see a lot of competitors trying to go for the same chance. So you have to assess if those founders gonna dedicate their life to just achieve this one goal. And in most of the cases, that's gonna be done in cost of family or whatever. So it's very hard decision to take in life. And not all of the folks who are starting some ventures are dedicated enough to go towards the success with it. I'm happy to see that now some of the investors are trying to use some psychometry and some other forms of checking on founders instead of just checking if they got MBA from Harvard, Stanford, or whatever, because still there are some funds which got just very basic checkbox, and like on a first thing, what they do, if the deck is pretty interesting, they check if the founder had been in like Facebook, Google, and got MBA, which I think especially in Web3 is not relevant, as we see that there's a lot of very successful founders with great ideas who achieved to grab a lot of attention in the market. For now, we don't know how it's going to look like in 5 years, but for now, their products are quite successful, and they don't have, for example, any studies and never been working in any FANG company or whatever else company in Valley. So this model is changing, but for sure, still assessing the founders is the most important metric. When it comes to early stage investing. When it comes to more growth investing, like from Series B upwards, then of course you need to start checking the product market fit and actually how much revenue the company is generating. Is this revenue sustainable? So is it just a one-time gig that they made actually this amount of money last year? Is it still possible they're gonna make the same amount or even bigger on the next year? And start doing some analysis and forecasting how the business is going to look in like 1 year or whatever. So it's really two kind of approaches. It's depending on which stage the venture is.
But I'd say that oftentimes it wouldn't be the case that, for example, a Web3 company is making actual money, right, or revenue, because mostly they might, issue a token and it depends on, the token growing in value, right? So is that also part of the assessment?
Yeah, so of course, like Web3 investing is much different than what in traditional VC we could
traditional
see.
is probably also, we're talking about a tech-oriented VC, right?
Yeah, of course. Like most of the VCs and like the whole history of like VC industry is investing in tech. And later on, it became like also investing in some other frontiers, like consumer-facing apps or health tech still, and any other vertical. But it all became started with tech. So here also I refer to tech investing mostly. And in crypto, you got token, which is still very new concept, still unregulated in most of the jurisdictions. Now we see what's happening in US, and it's very uncertain if I can establish my company there or not. Then investors are also more, US investors are looking more into deal flow coming from Europe and Asia, just because they're not sure how US authorities gonna look at tokens and if they can hold them, if they need to pay what kind of capital gains tax on it, and whatever, if they're securities or not. So of course, token is changing a lot in the model, but in the end, if you're not producing revenue in any way, I think in long term, it's just not sustainable model. So still, it's very big task and question for our industry, how we want to monetize all of that. So the most successful protocols like Uniswap, they just generate money. You swap, they take a fee, they generate money, right? And you could do that without any tokens. So Uni token is used for governance, right? And of course, like coming with the concept, like whole ethos of what we want to achieve with crypto and etc. This governance concept got some value. But in the end, it's best to just generate revenue somehow. And you can see, like, without maybe splitting some names here, that there are very big projects out there which are paying to produce some product for big brands from Web2. And this is not sustainable. And when they do it, you can see a lot of news about it. But in the end, the value accrual, you can't see it in a token. So let's say company A build a product for a very recognizable brand from Web2, and this Web2 brand is using this crypto product somehow, but in the end, as a token holder, you don't see any upside from this. So then, in a lot of the cases, tokens are just a speculation, unfortunately, in my case. And that's why more and more ventures are looking into structuring their financing rounds with an equity investment, with a token on top of that. So much more people this year in this market are looking into actually selling equity when you're raising money from VCs by tokens. But I believe that also that with tokens, we can set up a lot of interesting models, a lot of constraints and incentives for users to proceed with some actions. And thanks to this, we can have value accrual on a token as well. But then, of course, it's once again the due diligence on how this token actually can accrue the value. If, for example, all of the fees gonna be disposal of a token holder, and this is like my key to the, like, let's say, bank account of some DAO which issued the token. So yeah, that's it, I believe. But it's completely different world in crypto investments for VCs. But in long term, I believe we're gonna see much more these equity deals, and it already started happening.
Yeah, but then what about like the decentralization, the community, and this side of the Web3 ethos? Fair lunches have been a big deal recently. So is it like a VC stands on the opposite here, or they just won't participate in really decentralized products?
I don't think so. Maybe that they stand on the opposite side. It's also very much up to the founders, how they gonna structure around, and if the product is interesting enough for VCs to invest, even if they can't obtain, like, let's say 50% of ownership and get a seat in a board and actually manage companies somehow, because this is what they have been doing in a like traditional tech investing in most of the cases. But still, with like whole crypto, I believe we kind of far away from this whole concept of decentralization. Even if we look at the most decentralized network at the moment, which is ETH, most of the validators are run on one software, which is, then it makes it not really decentralized. Then also, like, big part of it is run on cloud. And when it's run on cloud, it's mostly on AWS, and then it's mostly in two countries, US and Germany. So I think it's like, we think of a crypto as very decentralized thing as a concept, and it maybe can be such. It for sure makes it much easier to distribute the ownership and include more users in the governance and make much more fair ways of going out to the market with any product. But I think we're still far away from decentralization. There are VCs, for example, which don't want to invest, let's say, in a project if they will be possessing more than, let's say, 20% of the network, so of the tokens. So I saw cases like that, but I saw cases as well that some VCs get enough tokens to actually, if they participate in any voting, they do whatever they want. So in the end, it's of course game on which you have to make profits as an investor, and this is what you mainly focus on. And then I believe that much more burden about the whole decentralization is on the founder. So if they're gonna structure the whole financing in the whole process this way, that decentralization can be as much as possible.
So how could a founder do that? By like limiting ticket sizes? What other ideas are there?
Yeah, so I think in a lot of cases we see a lead investor, and the lead investor in a round is taking, let's say, even up to 80% of a round sometimes, right? So one case could be just splitting the cake into more parts and just including more and maybe smaller investors on your cap table or token allocation, whatever they invest in. So that's for sure one way. And this is it mostly, I believe. But then it also come with this board seats, for example, and etc. And we have to see that sometimes, even if some founders are building the network, some decentralized products, but they still have some board of directors or whatever, and those people always gonna influence development of a product somehow. The same as the leadership in the company gonna do it. So I don't believe this like concept of being totally decentralized is even possible to achieve, that in terms that like nobody got enough influence to change anything in the company. Because imagine if Vitalik is gonna say something right now, if most of the ETH developers gonna pursue his idea, or rather just stay in the same state as ETH is right now. So we changed from proof of work to proof of stake, and it had been supported by a broad community. But I think like Vitalik was a like leader on that, and we can see it everywhere. So including more community, more people into governance can be a good idea. But also I think that some tech decisions, like important business decisions, probably shouldn't be taken by people who got no clue what is going on inside the venture. Then it's also not really the case that it's very wrong or whatever. And of course we should just try to set up our world in a way when everybody can participate in any activity if the person got enough like skills and expertise to do that. So that's my view.
Yeah, it makes sense. Of course, this is a similar game that the traditional finance is playing, right? With ETF issuers, for example, they have so much stake in most of the companies, right? I think like still Bitcoin has potential to be the most decentralized or stay this way, but still, we cannot be sure if someone accrued so much value that, they will eventually have enough power to do whatever they want. But anyways, this is like beyond VC principle, probably. So how are you using your experience now in Aleph Zero? What are you doing in your role?
Yeah, so as probably listeners to this podcast knows, we got this EFP, ecosystem funding program, which is 50 million sized. And I would say it's structured in three main pipelines. So first pipeline is grants. Then we got accelerator setup. So when founders are engaged with this, we provide help with the audit coming from Kiedelski Security, 10 Clouds when it comes to any designs and UX. And some other partners are involved on the accelerator setup, like Serotonin when it comes to marketing, for example. And the third part is the follow-on investments or just ecosystem fund. So I'm working mostly on this third pipeline, and in most of the cases, that's gonna be follow-on investments in the best use cases coming out from these accelerator setups and after receiving a grant. So if we from ALF Zero providing a grant or this accelerator setup to any founders, at the moment we're not taking any equity or tokens for that. So you can develop your company in a pretty fast pace, I would say, with a lot of help coming from foundation. And we're not taking anything for that. But then you're entering this stage if you want to scale a product that you need much more financing. And this is a time when you go for a VC financing in most of the cases. But of course, there are other ways, like maybe launching an ICO or whatever. But most of the founders just choose going for a VC money. And
angel investors, right?
Yeah, and angel investors, of course, right. And then we, from a foundation, also are participating in those rounds. So investing from like arm of the ALF Zero, and I'm working on that, doing research, what gonna be the use cases we actually would like to put more money into. And beside that, helping with structuring the rounds for those of the best use cases coming from the accelerator setup. So helping them prepare the data room, all of the stuff they need to have before they approach any VCs. And with our broad VC network, also connect them to the investors and help them just flourish, especially now in this very difficult market to get any financing. So that would be mostly that. Then like TLDR would be that I'm on the investment part of the foundation. And beside that, I also always try to help with the BD inside the team, but also for all of the portfolio companies, if I can get them any partnerships and etc.
So are there many projects, or is there any project that has reached this stage when they are looking for external financing or follow-on financing?
Yeah, so actually it's like to get a context, we like gave grants to or invested on our own in 38 projects from April. So when the EFP been established and when these smart contracts went live on the mainnet, most of those ventures gonna be live on mainnet probably Q4, maybe /Q1. At the moment, it's 4 ventures at the mainnet. And some of them are already entering this phase of financing, and it's more seed financing than a pre-seed one, because I think that we provide enough value and money, not taking anything for that to actually get through pre-seed stage without any external money and VCs involved. So we got already, I would say, 7 or 8 use cases which reach this seed level. And in most of them already involved with helping setting up, like structuring the round. The most developed one with my work with the founders is probably Kintsu. So the LSDs built on top of the ALF Zero, which gonna be very important building block for whole DeFi, because when we got around 11% yields on staking, then it's going to be very hard to get the same amount of yield coming from like really great sources. So if you don't have LSDs, it's hard to unlock all of the DeFi possibilities. And it's very important building block, the LSD product on Aleph. And a lot of investors see it because they see potential in Aleph Zero. Then they see that this is a product which is very needed in the ecosystem. Then this round is pretty competitive, even while looking at this hard market and hard environment to raise. And we working on getting the best investors to collaborate and also to structure the allocations this way that, as we just been speaking about a few minutes ago, that nobody in this round got like too big portion of a pie. So tokens are like distributed, and equity, because it's equity plus token round, is distributed in a fair way. And also that there's going to be a portion which just will be going directly to users in some way. So this is one of the ventures, but we got also GateKnox, which is KYC for corporate. So probably product of which a lot of users maybe don't know, because it's not very like retail user facing product, but we see a lot of interest among corporate enterprises in such a service. And the round also is looking very good and very interesting. And yeah, there are a few others like Interlock, but I would say that those two are the hottest ones to say at the moment. Yeah.
Yeah, so that's kind of a look behind the scenes on that. But also, what are your thoughts on the general climate around VC investments right now? Are they hesitant, or it's like if the product is worth it, it just happens?
Yeah, so both of that, I would say. So we just recently been in Singapore, so I heard a few times quote now, hey, do you know any VCs which are deploying now? So for sure, it's a very dry market. Really not a lot of people are deploying money, which is hard for founders. Also, it's very funny when investors are telling you that, hey, this is the best time to build because it's like bear market, but it's not true. It's a very hard time to build. You're not gonna get any money, so you're gonna not pay your bills and etc. It's a good time to invest, not to build probably. But yeah, so investors are very hesitant to invest. Valuations, they want much lower valuations. And still, most of the founders would like to raise at very high valuations, especially because, let's say, their main competitor raised 1 year ago, still, let's say, in more or less bull market with a high valuation, and they want to be valued at the same level, because if they're not, that means that their product is worse for a lot of people. That's going to be the message. So they don't want to agree on those lower valuations, and it makes the cycle that then less rounds are actually happening, because founders also don't want to raise money with this environment. So yeah, first thing, it's hard to get money, but still the best products, if they get reasonable valuation, it's pretty straightforward way to get the money if you got enough good connections to do that. So still there is a lot of funds which are looking to deploy money, but I would say that you could see much more of that in Asia than in Europe and US right now. So that's it. The other thing is that a lot of investors are now trying to do some OTC deals, because a lot of investors invested in a peak at very high valuations. Now their portfolio is very down, very bad, and they're pushed to sell their allocations or whatever. If this is liquid, even more, if this is liquid allocation, to sell to some other parties. So a lot of investors are trying doing liquid investments, and we see also a lot of VC funds which are now launching those liquid investments and looking into just buying also tokens on an open market, and if it's possible with a discount if they buy it from foundation behind the project. So yeah, it's very hard, but still, if you got great product and somebody to help you with proper interest, I think you can make it. And we still see some competitive rounds ongoing. Even here, as I mentioned, Kintsu, we see a lot of interest in that, and we don't have any problems in terms of getting the money. It's more like who will be able to provide the most value to the project. So we just got best people on board.
Yeah, we didn't touch upon this, but the VCs also provide much more than capital, right? Or at least the best VCs do that. The network they have, it's probably an important part of it, but what else goes into the package?
So it's also a meme that value add by investors. Yeah. So in most of the cases, that's going to be like some advice from a
pat on the
boomer.
back.
Yeah, who was working as an intern in some tech company 20 years ago and somehow made a lot of money. I think this is a meme, but in a lot of cases, it's like this, unfortunately. But yeah, the most probably scary resource is network, because you can't scale network. Let's say I know Vitalik, and if I connect one person, one founder to Vitalik, that's probably okay. And he gonna be like, yeah, that's fine. But if I want to intro like 10 people every week to him, he would be like, yeah, I don't want to get spam all the time. So this is very scary resource. Then that's also very important for founders to always update investors that they're the winners, they're the best bet, they're gonna be the unicorn. I'm a big fan of launching the investor update and sending the updates monthly in a short form, so they see that there really is attraction. And in this VC space, you probably, because it's kind of relatively small industry, you know all of the other folks. Then now, if you want to connect to more investors because you do the next round and etc., it's gonna be much easier if you have somebody good on board, and this person can serve you with proper intros. And if you got a warm intro, it's always different case than if you're trying to cold outreach somebody, especially investor. Beside that, there's like in some of the VCs, you got team dedicated to work with portfolio companies. So if one firm invested in a lot of use cases, it's a lot of times great opportunity to connect them somehow. So let's say I invested in Oracle. So now every project which needs Oracle, so that's going to be all of the DeFi stuff and a lot more, gonna need Oracle. I'm gonna connect them, and maybe even they're gonna get better price from this other investment of mine. So it's also a lot of synergies inside the portfolio. And beside that, VCs are in a lot of cases connected not only in Web3 but also Web2. So it's, if you got a good investor on board, it's always easier to go for some partnership. And that's it. But also as investors, if they're established and long time in the market, see a lot of patterns. And of course, as a crypto, it's like new industry, but some things are happening here in other tech sectors, and investors can actually see those patterns and maybe help you shape your venture better and like go faster to the PMF, or help you with some other concept like assessing key person in your team because you need to hire a new BD manager or whatever. So in a lot of the cases, VCs got a network good enough to help you with key hires and actually supply your team with somebody very skillful who's gonna help you scale. I think that's those three things. So connections, partnerships, and hiring. So that's it. And of course, like being an advisor, but that's pretty generic, I think.
Sure. And of course, probably you can help yourself if you're not the first time founder, right? Then you also have your own connections. Probably it's easier the second time.
Yeah, for sure.
Okay. All right. So I think we can also jump into the other topic that we had for today. Piotr has been a podcast host himself for quite some time already. And you can search for the Light Node podcast on Spotify or any other platform. So, yeah, I think we can already say that the Light Node podcast will be also part of the ALF Zero podcast, of course, still operating separately. So, can you share with our audience, what are your plans for that? What can they expect? Why should they subscribe?
Yeah, they for sure should subscribe because there's not gonna be an airdrop, but still gonna be valuable. But yeah, happy to share. So I'm doing this podcast for quite some time. I already got 2 seasons behind me. I'm super happy to have season 3 launch inside the Aleph. So as what I was just said, that's gonna be part of what we do in here with this podcast, but it's still gonna be some other branch. So what you can expect is still pretty the same content. So mostly I'll be speaking to investors from the Web3 space, but from time to time, maybe also with just people from tech and not only crypto sector. Most of the talks gonna be focused on investment, how the market looks like and what investors see, what are the major problems for founders in those times. But beside that, we also gonna talk with some tier 1 founders and just great people from a space, and all of that got a purpose to give people insight into how to build a successful company. But as my background is at investing, the lens through I look at this are a lens of an investor. So that's why there's more investors than founders in the podcast. But yeah, I think both investors and entrepreneurs can listen to it and got a lot of alpha from there.
Yeah, that's great, and I'm also looking forward to it. So yeah, I think that's a wrap for us. I don't know if you have any word of wisdom to share before we end this.
Yeah, I think that's it. I'm just happy to be here at Aleph. I see very big upside for the whole ecosystem, and yeah, just can't be happier than being here and be working on what we're doing.
Yeah. It's great to have you here. All right, so guys, we are wrapping this up. Subscribe to the ALF Zero Podcast, subscribe to the Light Note Podcast because new episodes are coming, as I've been told. So, yeah, and see you around in the next episodes.
Thank you very much. See you later on, guys. Bye.